So today's little platform that I got, I started to tell the listeners and you, I'm starting to really get into the Chat GPT AI stuff, and just kind of using it as instead of Google. And so here's what I did, everybody. I just said top financial tips to gain wealth in 2025. And if you think this stuff is easy, bear with us, okay? The very first one, which they make sound so simple, because oh yeah, it's really simple. If you're not going to get a 22.5% return doing this on your own. I'm telling you right now, I would no way I would do. I'd be losing money. The first thing, Craig, is they say invest in low cost diversified index funds. Okay, what is that? It's like they give
Well,
you this thing and it's like, oh, go ahead.
well, there's a couple of variables that you want to take into consideration, especially when you take that level of information as it relates to utilizing low cost index funds. An index fund is basically a fund that will mirror the securities or stocks or investments that are uh, inside an index. Like for example, you have the S&P 500 index, or the most common ones, S&P 500, the NASDAQ, and the Dow Jones Industrial Average. So the Dow Jones Industrial Average is only 30 companies. The S&P 500 is 500 companies. In theory, 250 growth, 250 value, includes small, medium, and large companies. So typically it's considered more of a blended type strategy, growth and value. Then you have the NASDAQ 100, which typically is some of the 100 more technology-oriented type indexes. So typically a lot more aggressive, typical over the longer term will outperform. Dow Jones, typically the 30 largest companies that are out there, and usually more global in nature as well. So the purpose of looking at these indexes and comparing a portfolio, that is where most portfolio managers will want to compare against. But there are thousands, hundreds, if not thousands, of different types of indexes. You have the Russell 1000, 2000, 3000, 5000 indexes. All of them measure, are used for specific or different types of measurements. So Fidelity, Vanguard were some of the larger companies that started creating indexing, allowing people to invest in a very broad, diversified portfolio with small amounts of money. And so with the indexes, they basically, it's giving you the opportunity to take a couple dollars, put it into an index fund, knowing your portfolio is going to be diversified, and you won't have to worry about buying into a stock that goes bankrupt or in a company that goes bankrupt and you're losing money along those lines. Plus, you're going to have some companies that go up, some companies that go down. So it gives you that broad diversification. Well, what happens then is that everybody starts having an index fund. You got BlackRock has their S&P 500 fund. Vanguard has their S&P 500 fund. Schwab has their S&P 500. All of them are S&P 500. They all have the same stocks in them. So now they start talking, get into a low cost S&P 500. The performance is going to be roughly about the same, except the net of fees. So now you start having this battle, if you will, between financial advisory firms of offering the low cost investment products, presuming that cost is what is going to be driving performance. Cost doesn't drive performance. One of the ideas that I always kind of address with clients, there's two things that's going on in the markets. You're buying a stock, you're selling a stock. That's it. And then the index is a measure of an aggregate of people buying stocks and they're selling. So if you have a lot of people buying a lot of stocks, the markets are going to go up. If you have more people selling stocks than buying stocks, the markets are going to go down. But in the end, all you're doing is buying a single stock and you're selling a single stock. Some institutional managers are better than others. And so you could have an index fund that you pay 0.12 basis points and have the same volatilities of the markets going up, down, whatever it might be. Or you could spend 1.5%, 2% or whatever and hire a person to actively manage a portfolio, and you won't have that level of volatility when you're in withdrawals. Or if you're looking to try to outperform the markets, you could actually outperform the markets net of fees. So you want to look at what net results are. So to address that question, when you're looking at ChatGPT going out there and looking at some of those questions, they're going to look at the broad market and they're going to say, okay, here's what consensus says about indexing.
I wouldn't even know how to even, I wouldn't even know how to attempt this. So, Craig,
Well, you
why
do,
would they take that number two?
you did that when you started working. Leveraging tax advantaged accounts is a 401k, a 403b, 457. Any tax deferred vehicle that allows you to have money taken out of your paycheck before you see it that you do not get taxed on. And then inside those accounts, you can manage them however you choose. So rollover IRAs, traditional IRAs, Roth IRAs, tax sheltered annuities, a wide variety of products that can be utilized to grow tax deferred or tax free like a Roth IRA are products or accounts that can be applied depending on what the client's needs are, right? So 90% of the time when I'm talking with a client, if they want to reduce their tax liability, the best way to do that is to defer as much as they can into their existing retirement plan. And I think this year, with catch-up provisions, you're looking at being able to defer north of $30,000 with any match. A person can defer north of $60,000. I think it's up to 66 to 70,000 possibly in 2025 that a person can defer. Now, do I know a lot of clients that actually have that ability to do that? A couple, but the most folks, that conversation becomes how much can you actually defer without disrupting your existing lifestyle, and how much of your lifestyle will we need to change so you can save enough so you can retire at the desired goal that you want to retire at. How much money you want to have in assets, what type of income you want to draw off, and then we make that decision as to where to place the investments and what strategy, and whether we hire an institutional manager, utilize an insurance product and or annuity. Yeah. So it's a wide variety of ways to address that particular question. But you've already been doing that as an example. A lot of folks who are already investing in their 401ks is doing exactly what you just.
And I'm glad I know that I did that because
Yep.
it's like I didn't know it was. I knew how it works. I just didn't know that the term, and I'm sure many people don't because I'm just like lots of other people out there.
Well, I mean, the big thing that threw you off, I imagine, was leverage. Leverage was basically take advantage of 401ks, retirement plans, of these tax advantaged accounts, because there, the more you can put into it, the more aggressive you can be inside those, because the advantage is the tax deferred growth and or tax free growth. So when I'm talking with clients, I typically want to be more aggressive in those accounts from an investment strategy standpoint and growth wise, because especially with the tax free, the advantage is the tax free growth. And if you're buying CDs in a Roth IRA, you're not utilizing the Roth IRA the way it could be, right?
Today's topic: top 5 financial tips to gain wealth in 2025, thanks to Chat GPT. This is why you really you got to have a pro help you with this stuff. I mean, I'm so glad I do. This just clearly illustrates that it's very, very complicated. So we started the thread, diversify with real estate investments. And Craig, you said that we're going to come back and talk about pros and cons. And I'm dying to hear this one because it's like, well, yeah, I mean, real estate investments can be very tricky, but all investing can be tricky. And that's why we need Desideri and we need you and Ameriprise. Go ahead, please.
Well, there's a couple of factors when I sit there and think about all the questions that you're asking as it relates to ChatGPT and the specific question about 2025. ChatGPT is going to go out there and look at the markets and basically extract everything and put together what the consensus might be in regards to what to expect from 2025. So kind of tying all of that in together, one of the areas that you see opportunities are within the real estate investments in general. And there's several ways in which a person can invest in the real estate. One is through REITs that we talked about. Those are stuff that's kind of publicly traded. You can go ahead and buy and sell, provides a level of liquidity. You can buy them through private equity, to where if you qualify, if you're what is considered a qualified investor, and sometimes that to be a qualified investor is a pretty high hurdle. A person makes a minimum of $250,000 a year. They may have to have a minimum net worth of like $5 million or so to be able to have access to some private equity investments. But then when you put a significant amount of money with these investment firms, you can get decent returns, but you may not have the liquidity, may not be able to touch the investments for a year, 2 years, 3 years, 5 years, 7 years, depending on what it is. And then you get a huge payday a little bit later on. So there's a lot of pros and cons to these different types of products. I always tend to approach my financial recommendations based on the client's need for liquidity. Okay. So when a client is wanting to invest into an investment or like a rental property or something along those lines, I understand that they're investing into the rental property with the intent of increasing their monthly income. But that's going to take capital. How much capital, where they're going to get the loans, are they going to take it out of their investments? So they're going to take a couple $100,000 out of their investments, buy a rental property with the intent of getting a good amount of income. We evaluate what that income is going to be, net of taxes, net of expenses, net of upkeep, net of whatever it might be. Because it may say, I want to buy the property for 200,000, but I got to put another 50,000 into the property to get it livable, to change the carpet out, whatever it is. And so all of those conversations become a very important piece of that client's retirement goals. So are they planning on buying the property with the hopes of selling, getting income now, but selling the property for appreciation 5, 10, 15 years from now? And if they are, what is their expectation of that growth and value of that real estate property? Because you're not going to know what that value is until you're ready to sell it. The other being a cash flow issue is you take a couple $100,000 and you're doing it without mortgage. Now you have access or equity in that property. If you need access to that equity, the only way you're going to get it is by selling it, mortgaging it, or somewhere along those lines. And then we need to determine, if you do mortgage it, are we going to be able to get the cash flow, enough cash flow out of it to pay the mortgage as well as sustain your lifestyle? So all those variables come into play. And then it comes back as a diversifier for your portfolio, right? Is it a good diversifier? It's tough to say, especially if it's assets that are not daily liquid or daily valuable, like a REIT is. A REIT, you can go through and take a look what the valuations are, and REITs can be structured in a wide variety of ways. You can have REITs that invest only in warehouses, REITs that invest in apartment complexes, REITs that invest in corporate leases, right? Leasing properties. So there are a wide variety of products that generate different levels of income, and that income gets taxed at a different level as well. So a wide variety of ways can be used to diversify a client's portfolio. 2025, there are a lot of reports that are out there that saying real estate is a positive investment to be in. But how much of your portfolio do you want to have placed into that, and does it make sense? And
Exactly.
so again, from that standpoint, I always look at it from a cash flow perspective and what a client's needs are. Because if I take a chunk out of their portfolio, that's a chunk that we're not actively managing. So if a client needs additional cash flow that their liquid portfolio can't generate, we need to make sure that the non-liquid portions of the portfolio is generating enough income to offset the assets that we removed to meet it. So
I love Craig Stiles. He is just the best guy ever. I can't say enough about him. And so, I mean, we're gonna set up some stuff. We're gonna try and bring you some more video presentation with him that is not radio specific, but video specific. That's what we are just talking about. If you watch the video, you just heard it. Um, to just try to help you stay financially fit in 2025, 2026, and in the future. Okay. So, with that being said, I'd like to say thank you so much to everyone who subscribes, listens, watches, all of our good things. We appreciate you. I love you all so much. I'm Papa Tom. This has been the Tom Matt Show with Craig Stiles. Thank you so much again for what you do, and we are out. Peace out. Please support our sponsors. Thank you.